So how do banks put money into circulation? How do banks create money? When a bank gives out a loan, a bank loan, the money for the bank loan doesn't exist yet until you get the money paid to your account. That is the creation of new money. So effectively, banks don't lend money, they create money. And they create it when they do what we call a bank loan. So the money for a bank loan, which is the technical term is bank credit, credit creation, that is new money creation that newly adds to the money supply. So the more banks do what we call lending, normally, the more money is being created and added to the money supply. Now, of course, even though banks do this and they create the majority of the money supply through lending, central banks, of course, are very much aware of that. Now, I produced the first empirical paper, empirical test to prove this, because that was controversial. And a few years ago, people were saying, oh, that's a conspiracy theory. What's Professor Werner saying that banks create money? What a conspiracy theory. So I thought, well, and for 100 years, there's been this debate about where does money come from and how do banks actually work? Because today, if you look at the latest finance journals and finance textbooks, they all say, oh, banks are just financial intermediaries. They gather deposits, and the money they lend out is the deposit money they're lending out, which is not true. But you see, that's how they hide the reality of money creation. So I did an empirical test. I mean, what's the scientific thing to do? Can you believe it? For 100 years, economists have been arguing, oh, it's the financial intermediation theory of banking that's correct. And a few were saying, no, it's the credit creation theory that's correct. Others were saying it's the fractional reserve theory is correct. That's a third theory, which is in between, which says that each individual bank is just an intermediary, but somehow collectively there's money creation in the system. That one was popular until the 1960s. And then currently, since then we have the current financial intermediation theory dominating, which says, no, banks don't create money. We've got three theories of banking. How do we find out which one is true? Do a scientific test. And so I did that. You need the corporation of a bank. I found one that agreed and let me look inside under the bonnet, so to speak, how the money creation was actually taking place. And I could empirically establish, this is in two peer-reviewed, published in peer-reviewed journals, published articles, that it is the credit creation theory, the oldest, which was known until 100 years ago, that banks create money out of nothing when they lend. Now, the key is this. Because banks are so powerful, they create new money. They actually have a lot of influence over how the economy is going to be shaped currently and in the years ahead, because the decision by banks of how much money to create and then also who to lend this money to, for what type of transactions, for what purposes, that will reshape the economic landscape very quickly. And basically, there's three scenarios. If banks create credit and it's used for asset purchases, property, real estate, financial assets, because bank credit is money creation, it's like printing money and injecting it into, say, the property market. What's going to happen with property prices? You don't need a PhD to figure this out. You're going to push up asset prices. Exactly. You get asset inflation if you have bank credit going into asset markets. And that's very bad because that's an artificial asset boom, which is unsustainable. And if you keep doing this for a few years, the moment the music stops and banks stop creating credit for asset purchases, asset prices will not go up any further, but then the late coming speculators will go bust. And then the banks have non-performing loans. They will reduce lending even to the economy. You get a recession, a downturn, and a banking crisis, because essentially the assets are the collateral for the loans. And when you have this asset bubble, usually asset prices go up 100%, 200%. And from that peak, if they only drop by around 10%, you have a banking crisis because you wiped out bank capital.
And that's
because
what happened in Japan.
loans have to be paid from bank equity.
So that's what happened in Japan.
Precisely.
Is that what also happened in 2008?
Yes, that's also what happened in 2008. In fact, I warned in my book, Princes of the Yen, that from what I found out, and I met Alan Greenspan, who was at the time heading the Fed, that he was on track to do the same thing. And as it turned out, as his successor in the US. And I warned in the last chapter in Princes of the Yen that if the Fed keeps on doing that, we'll get the same thing in the US, but this time much bigger, and will lead to a global financial crisis.
Yeah.
Because that's what happened in 2008.